This is Bloomberg.
"24 seconds away from the opening bout this morning. Good morning to you all. Here's the price action this Tuesday. A little bit higher by 1% on the S&P 500. On the Nasdaq, up by 1.24. Didn't get too excited about the gains yesterday either, given the fact that they don't often stick, and they faded yesterday too. Futures elevated on the S&P, the Nasdaq, and on the Russell. There's your opening bout. Switch at the board and get to the bond market. We look a little something like this on Treasuries. Yields unchanged at 298.18, still sub 3%. Crude pulling back. Had a little look at 100 earlier, back to 101. We're down by 1.56%. The euro, the epicenter of all the price action, all the fun and games, if you want to call it that. On Thursday, euro dollar 102.43. That currency pair up by about 1%. Bear in mind that in G10 this morning, it's a weaker dollar story, but in Europe, there is so much to talk about this Thursday. The ECB, according to sources, considering a 50 basis point rate hike. The chief economist of the European Central Bank will propose that idea to the governing council. They'll have a think about it. President Lagarde, apparently, also according to people familiar with the matter, doubling down on her effort to come up with that new bond buying tool, the anti-fragmentation effort. Let me translate that for you. That's to stop Italian yields going higher at the same time they hike interest rates to do something about inflation. Throw in the fact that they're also considering what will happen with Nord Stream 1. Will the gas come back online? The European Commission basically telling us now that their base case is that is not gonna happen. What does that mean for rate hikes? Not just this Thursday, but beyond into year end. I'll bring you that story a little bit later this week. Right now, about a minute into the session, we gained by about 1%. I can tell you every single industry group on my screen is in the green. Energy, the relative underperformance, but still delivering some positive returns, up a third of 1%. Consumer discretionary up by about 1.4%. The financials up by 1 full percentage point. IT up by about 1%. Bear in mind, a lot to discuss on the information technology front next week. After the close today, we hear from Netflix. Then next week, next Tuesday, Microsoft and Alphabet. On the day of the Fed decision, you'll get Facebook after the close. Amazon and Apple, they come up on Thursday. We'll talk more about that in a moment. About 2 minutes into the session, let's get you some movers. We can do that with Katie Lyons.
Well, John, let's kick it off with one stock moving lower by more than 5% at the opening bell, and that is IBM. The interesting thing is you actually had a beat on revenue, its strongest growth in more than a decade, so demand isn't a problem. The problem is that they lowered their free cash flow guidance in part due to the lack of business in Russia, the other part due to the stronger dollar. And you have J&J feeling that as well. Yes, the stock is clinging to somewhat of a gain here at the opening bell, up about 0.4% because it delivered a strong second quarter, but it cut its full year EPS outlook again because of the stronger greenback. And as we know, we've already had Microsoft warning about that in recent weeks. As you said, John, we'll get more details on that from them next week. And we know that the dollar is indeed strong, John. The DXY is up about 11% year to date, heading for its best year since 2014, betting on a hawkish Federal Reserve, a bid for haven as growth fears out there mount. We're now near a 2-decade high, currently trading around the 106 level, but Andrew Sheets of Morgan Stanley told us we could see 112 on the dollar index before too long, and that would be an even bigger headwind for some of these multinational companies. Think about it. IBM, Microsoft, J&J, all of them get about half of their revenue from abroad, and it's similar from other big tech and pharma companies as well. A lot of those sales are coming from overseas. And you've said this plenty of times before. There's kind of a double whammy here, because think about an economy like Europe. If you were trying to sell product there, you are already dealing with a growth slowdown, which could hurt demand and sales as a result. Then coming back the other way, the value of those sales goes down because of the foreign exchange headwinds. It's a problem for a lot of these companies.
Kelly, I have to admit, I did a double take this morning. It was Andrew Sheets of Morgan Stanley with Kelly and I and Tom Keene earlier this morning on Bloomberg Surveillance. He said 112 on the dollar index. Kelly, the first thing I thought of, given the euro's weighting in that basket, in that dollar index, where's the euro if the dollar index is at 112?
That's the question, John, is how much of it is actual dollar strength versus weakness of everything else? The euro, the yen, you name it, everything in G10 materially weaker against the US dollar. And do you have to bet on those trends continuing for the dollar to keep climbing from already the most elevated level going back to the early 2000s?
Kelly Lyons, thank you. Weaker currency for Europe, more problems. You know the story at this point, don't you? A weaker currency, the inflation story gets more problematic. You import even more inflation. Inflation right now at an 8 handle. The last thing this ECB needs right now is a weaker currency on top of everything else because it already has a weaker currency after breaking through parity in the last week. Promised you more on that Bank of America Fund Manager survey, didn't I? Let me just bring you some of the headlines. At the top of the piece this morning from B of A, it had a quote, "I'm so bearish, I'm bullish." And then you go through every single point, every single answer to every single question, and I don't think you can get more bearish than this. Record low growth expectations, record low profit expectations, equity allocation the lowest since 2008, cash levels the highest since 2001, expectations for a recession the highest since April 2020. There are these peaks when you look at the net percentage points saying recession is likely. You look at the chart that B of A points out. You have this peak in March 09, this peak in April 20, and this peak in July 2022. There's the chart right there. I've had a ton of feedback about that chart this morning. I think the top pick, the best feedback I've had so far this morning on those three peaks came with John Stepek on Twitter of Money Week, when he essentially said the following. One thing I'd point out about the red dots on this chart for those feeling a contrarian buy coming on, April 09, epic central bank loosening, April 20, epic central bank loosening, July 22, and then he just wrote spot the difference. And I think that is the big difference for investors. This Fed and central banks are facing a very different inflation backdrop, which makes it much more difficult for them to respond to a growth slowdown. If you want an example of that right now, look no further than Europe. Greg Peters of PGIM earlier this morning calling it the EM dilemma. That is the classic EM dilemma. When you have upside risk to inflation and downside risk to growth, and you have to pick the least worst option. I don't think there is an optimal policy choice for the ECB this Thursday. They just have to pick the least worst option, and there's a big debate about what that actually is. For investors, it's pretty clear on this program, across this network, investors are preparing for one thing: recession.
Sentiment is quite low.
Sentiment very weak.
We've got earnings season.
The economy is slowing. We're heading into, I think, a more earnings-constrained environment.
You're seeing demand slow. You're seeing inventories build.
Positioning and valuation is very bearish. We're playing defense.
Rates are up. Investment sentiment is down.
It wouldn't surprise me that we, see a recession very soon.
So no desire, is it too premature to position for that theme, that recession?
I think we skipped a step, which was the actual slowdown, which would in turn require inflation to come down a bit, would imply inflation would come down a bit. I just want to, listening to that series of comments, I would just say, if we look back at, I think it was October 2018, we had 10 years at 325. We had 2 years, I think it was below today's level, just maybe 288 or so, and we had inflation just above 2% and unemployment at 3.7%. So it's one of those spot the difference questions. When I see already rate cuts being priced into the next year, and I compare it to where we were in October 2018 and where we are today, it feels like we are skipping a step. We are already jumping the entire actual reduction in inflation, which really does have to be a bit of a precursor. I'm not saying we get back down to 2, but we need to see substantial reduction in important core and headline measures, be it PCE or CPI, I think, before we see us get to that
the point
stage.
you've made repeatedly with me, and I've heard it loud and clear, you think it's too premature to dismiss inflation fears. Goldman's Peter Oppenheimer agrees with you. Take a listen.
The data we got last week suggests that core inflation is still rising well ahead of most people's expectations, and it's pretty broad-based. So I think it's premature to believe that inflation is really going to come down quickly.
So you agree with each other? We may have seen this mechanical peak in year-over-year inflation.
Yeah.
I think the point that you're driving home is this can be sticky. It can remain elevated for longer. What kind of numbers are you thinking about? 4, 5, 6, 7? What is it?
Are we talking about headline CPI? I'd say that, look, next month, I think we could, if we get the full 10% reduction in gasoline prices in the US, you're still probably looking at an 8% handle. And it's far from clear that we're going to get a steady decline in gas prices here in the US, because this is an international commodity. And it's hard to believe that if we get Nord Stream not opening on the gas side, that there would be no follow-on in terms of fears on the oil side with respect to what Russia could or might do. So I see a pretty volatile period, and I think we could probably end this year with inflation, as I've mentioned before to you, Jonathan, closer to 8 than to 7 or sub 7. Certainly. Oof. And importantly, I think rental inflation is, and home inflation, not house prices, but owner-occupied rent, that could stay somewhat elevated for a period ahead as well.
That's the difference in opinions after the inflation print last week. There's two ways of looking at it. We've seen gasoline prices come down. We've seen commodity prices come down. It's a group of people that look at that number last week and say that's the worst of it. The inflation story is going to fade. There's another group of people who look at the shelter costs and that story, rents and all of that, and they say that's the reason this is going to be sticky. Standard Chartered, Sonal, put this out in the last 24 hours, just their expectations for rates. And I know you're going to have a different view. Let me set it up. They look for 75 this meeting. In September, they look for a move of 50. Then they look for a move again in November. In fact, not in November. They dropped their call for 25 in November. Essentially, let me add it up and avoid the confusion. They leave their 22 year-end target at 3% on Fed funds. And they think essentially it will be left there throughout 23 because the economic slowdown is going to grip this Fed. So no, you're not at 3, are you? Where are you at year-end on Fed funds?
At year-end, we might be at something like 350, but I think the peak Fed funds is going to be 4. So I don't think the Fed's finished by year-end, which is a part of the reason that I think that the rate cut story already from, I don't know, maybe Q2, it moves from Q1 to Q2. It's far too optimistic in terms of what the Fed's reaction function is going to be. I hear a lot about the Fed not compounding one error with another error, with the other error being driving a recession. But what about the other error, which is to stop and start cutting to find inflation beginning to pick up again? That has happened. We have had that experience in the 70s. I would be much more inclined to think that the Fed does raise closer to 4% than 3%, and then keeps it relatively high for an extended period of time to make sure that we've gotten this under control.
And that's the flip-flop Fed that Mohamed Al-Erian has warned about, the risk of that actually taking place. So now, I wanted to finish up by working out how you'd push this through this bond market. I assume that leaves you bearish the front end. What does it mean for 10s and further down the curve?
So the further down the curve, as I look at 10s, there are a lot of question marks, right? Here's the thing. If I'm expecting Fed funds to end at close to 4, I really am not expecting 100 basis points inversion at the 10-year point. So I would assume even if you do get an inversion, and by that point, absolutely we will, I still see room for 10 years to sell off a solid 75 basis points from here.
Wow.
Now, does that happen by end year? Probably not. I would say, as the market goes in and out and we continue to watch Fed speak. But by end of the cycle, I do think we could see that.
Hey, Sonal, lucky to catch up with you. Sonal Desai there at Franklin Templeton on the latest in this bond market, pushing back against this idea that we've seen the peak in inflation, that it could be stickier for longer. This idea that ultimately, in Sonal's opinion, that we're going to get higher interest rates from this Fed, peak around 4, maybe sometime next year, because inflation could stay near 7 to 8%. Year-end. Some big numbers from Sonal Desai and the team over at Franklin Templeton. Decent move this morning, 13 minutes into the session, at 1% on the S&P, on the Nasdaq up 0.9%. I'll break it down for you. Energy doing okay, up 1.9%. That's a turnaround. Consumer staples up 0.7%. The financials up by 1.7%. Information technology up about 0.7% this morning. Coming up, big tech in the spotlight in a week ahead for earnings.
I don't think tech is immune from a slowdown, and I think there's parts of tech in particular that are going to be hit harder than others, and I worry about the semiconductors, for example.
That conversation up next.
don't think tech is immune from a slowdown, and I think there's parts of tech in particular that are going to be hit harder than others, and I worry about the semiconductors, for example. I like software, but I do think we're probably going to see some softness in software as well. I suspect the guidance is not going to be quite as positive as we might have been accustomed to.
Anastasia Amoroso there of iCapital, looking ahead to earnings season on the tech side of things, leaving behind the financials. About 17 minutes into the session, the S&P 500 up by almost 1%, the Nasdaq up by 0.8%. Big tech gearing up for earnings season, IBM kicking things off. Get ready to hear a lot of this. They blame some of the weakness to two things: the US dollar, it's too strong of course, and the loss of business in Russia. Katie Lyons, I wonder how much more of that we're going to hear this earnings season.
My guess is a lot of it. The stronger dollar is probably going to be a primary theme, John, and obviously IBM taking it on the chin as a result. It's down more than 7%, potentially heading for its worst day since October, even though you actually had a really healthy beat on the top line and strongest revenue growth in more than a decade. So demand is strong, but you have all those other headwinds that you have to contend with here. So that dollar story, in addition to hiring trends or lack thereof, as well as just broader consumer demand, definitely going to be big themes to watch in this tech earnings season. Of course, on the dollar, we've already seen warnings on that from Microsoft, for example. It will be reporting next week along with Apple, Amazon, Alphabet, Meta. A huge chunk of the weight of the broader market will come next week. This week, though, we have Netflix, of course, kicking things off after the bell today, then Tesla tomorrow, Snap on Thursday, and on Friday, we will be getting Twitter, though Twitter, of course, has this whole other thing going on with Elon Musk that we don't have to get into. For the other three, though, Netflix and Snap, they're each down about 70% year to date. Tesla is down 30%. So it goes without saying that sentiment isn't great heading into these prints. After a 35% drop in Netflix's last quarterly report, I'm wondering how tomorrow is going to play out. And when you think about how investors think all of this is going to play out from an earnings perspective, or at least analysts when it comes to their growth expectations, we are expecting it to stall in a big way. Long gone are the days of the pandemic when we saw growth north of 40%. In total for the technology sector, we're expecting profits to be up just 1.6% in the second quarter. In the third quarter, they think growth is essentially non-existent, John.
Kelly, thank you. Looking ahead to Netflix as well. Kelly and I were talking about this. The quarterly moves off the back of the quarterly earnings, the stock price moves. We had a 35% move, single day price action after earnings from Netflix last time around. Before that, it was 21.79%. The moves have been huge, and the big numbers come next week from the big tech players. We'll go through that through the week. Elsewhere in D.C., Secretary Yellen calling on U.S. allies to shore up global supply chains.
Friendshoring is about deepening relationships and diversifying our supply chains with a greater number of trusted trading partners. The purpose is to lower risks for our economy and theirs.
For more, let's bring in Bloomberg's Josh Wingrove live from the White House. Josh, great to catch up with you, buddy, as always. What's the number one effort for this president right here, right now, as he returns from the Middle East?
Well, I think right now, John, they're trying to see what they can get done out of Congress on a reconciliation package. He got sort of broadsided by the revelation that Joe Manchin doesn't seem to be on board. Now, there's still a lot of moving parts on that. They're also watching whether they can get that CHIPS bill, that semiconductor bill, through Congress, but that's a sort of like tension where they have right now, because they're running up against deadlines on reconciliation rules that would enact some of the things that they are trying to do. So, you know, Joe Biden would love to know what Congress is going to give him heading into the midterms and the midterm cycle. Right now, it doesn't look like a whole lot. Of course, yesterday they were out taking a victory lap on the decline in gasoline prices here in the U.S., down about 50 cents a gallon over the last month or so. Of course, they were asked in the briefing, the price hike was Putin's fault, and now they're taking credit for the price decline, but they're pointing to their SPR sales as part of the reason for that. And you know, finally, it looks like they're going to start doing executive actions, which are often not very pretty toothless, if you will. Instead of some of the climate measures that they wanted to do with Joe Manchin, Washington Post reporting, John, that he's considering as soon as this week maybe declaring a climate emergency, which would unlock some things. But again, all of this is much weaker than would come if he could get a bill through Congress.
Oil companies getting less greedy over the last 35 days, Josh, as you know. Josh Wingrove from outside the White House. That seems to be the story. 35 days slide for gasoline prices. Good news. We need to see more of it, that's for sure. Wanted to finish up this morning by talking about the ECB and bringing in Mike McKee. Mike, just a final word on the European Central Bank. We saw this with the Wall Street Journal in the last Fed decision. We're seeing it with this ECB decision. Is forward guidance and the post-financial crisis communication effort, is it dead, Mike? Is it over?
No, as a matter of fact, there were a lot of talk last week at the conference I was at about the efficacy of forward guidance. It's just a question of timing because the details keep getting worse. You don't really want to be in Christine Lagarde's shoes. You take a look at what they're facing over there. We got the news this morning that inflation last month in the Eurozone was the highest ever since the Eurozone itself was created, still 8.6%. And then you look at natural gas prices there are continually high and may go higher, and so we have all the way over on the right-hand side a bump in what people are expecting from the ECB. Maybe they do 50. Sources are telling Bloomberg that that is now on the table. We'll take a look at why they are having such a hard juggling problem. I mean, the inflation calls for a rate increase, and we don't know if Russia's going to turn back the natural gas on Thursday as well. But the recession odds there are rising because of all of this, and on top of all that, tomorrow we'll find out if the Italian government is going to collapse, which leads to another problem for the ECB. Fragmentation, the Italian yields above German bunds very high, the euro falling. They got to come up with a tool for that. They are really up against it.
This Thursday, I'm not sure you can provide any kind of forecast for the European economy that this ECB can rely on. Mike, wonderful to catch up with you, sir. Your trading diary is up next. Twenty-six minutes into the session, here's your price action at 1.1% on the S&P, on the Nasdaq up by 1.12. Busy week ahead. Here's your trading diary. What you need to be watching this week: the White House press secretary holding a news conference at 3 Eastern, Netflix reporting earnings after the close, Tesla reporting on Wednesday, rate decisions from the BOJ and ECB out on Thursday, alongside another round of jobless claims in the United States. And finally, rounding out the week with US PMIs coming up on Friday. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Looking forward to covering those central bank decisions and all those earnings with you. This was the countdown to the open. This is Bloomberg.
from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, July 19th. Here are the top market stories that we're following for you at this hour. Dire outlook and full capitulation. Bank of America's latest fund manager survey highlights a pessimistic outlook and high cash levels. We speak to John Waldron, Goldman Sachs president and chief operating officer, on the state of the markets and the economy. From big banks to big tech, you got IBM sinking as the stronger dollar hits its outlook. Apple's will slow hiring, and Netflix earnings are on deck. How to find that bottom in tech stocks. And on your marks, get set, bake. Record temperatures in the U.S. New York City faces, UK I should say, New York City faces 90-degree heat. Europe does not expect Russia to turn the gas back on. It is the next episode of the energy crisis. From New York, I'm Alex Steele with Anna Edwards in London. Guy Johnson is off today. It's a genuine question, how hot it is there.
Absolutely. It is, well, we've reached record temperatures, Alex. We're going to see if we reach beyond 40, beyond 104, I think that is in Fahrenheit. But that's one of the preoccupations here in Europe, of course, is the heat for a serious, threat to life perspective, but also in terms of disruption to people's day-to-day life. And if you're working from home, you're really missing the aircon in the office, is all I can say. Such low levels of air conditioning in many parts of Europe, including London. But we're really dominated by thoughts about Europe this week, aren't we, Alex? Mm-hmm. But taking time out from that to think about the big tech themes coming from the US.
Yeah, so you have sort of idiosyncratic stuff going on. You still have earnings coming out here, IBM front and center from last night about that strong dollar story. And then you have the ECB, of course, and what happens with that Russian pipeline, Nord Stream 1 on Thursday. So let's get to the story here in the U.S. because you have tech still up. You have the NASDAQ up by about 1.3%. You can really see that you make the argument that it has found a bottom just in the last few weeks. So that gets to the question of the day, is it time to buy tech? I want to bring in Alex Webb from Bloomberg Quick Take and Gina Martin Adams of Bloomberg Intelligence. Alex, let's just start with you. Coming from that IBM number, stronger dollar, Apple slowing hiring, but yet the overall tech is up.
It's clearly Apple was a bit of a shock to the system, and that I think the 2% decline we saw yesterday speaks to some of the skittishness surrounding stocks which previously had been considered quite resilient, and that sort of top tier of tech stocks like Apple, like Google, Facebook, perhaps less so Facebook, Meta, had been considered a slightly different class from the second tier ones. But it is worth thinking about the price to earnings ratios of these companies, that actually over the long term they tend to trend in line with much of the S&P 500. They still, even though they've corrected a little bit, are trading at a premium to the rest of the market. So you can see in this chart that there's about a three times price to earnings multiple discrepancy or disparity between tech stocks and the rest of the market. So that might suggest there's still some way to go, unless, and Gina might have views on this, people just generally think that tech should trade at a premium.
Yeah, Gina, coming on that point then, Alex making the point that, versus history, if you compare valuations in tech versus valuations of the broader market, there's still a premium in there for tech stocks that was sort of earned in the run-up to the COVID pandemic and then through it. Do we look to unwind all of that premium, or do we look to go back to a point where, yeah, sure, tech stocks are going to play a bigger part in our lives, and so they deserve to keep some of that premium?
I think a lot of it will depend, frankly, Anna, on where interest rates go, because you would derive your expectations for the premium for the sector based upon where short-term interest rates are. If interest rates are indeed going to 3.5%, that would certainly mark a much higher level of short-term interest rates than we saw even in the pre-pandemic era, which would mean that valuations probably should be quite a bit lower for this long-duration sector. But if you think interest rates are stabilizing, you make a very different argument. I think the market has gone a long way to pricing the most likely outlook for interest rates, and that's why we've started to see some stabilization in this space. Mm-hmm. But it does remain to be seen, and certainly the monetary policy making here in the U.S. has moved at a much faster pace than expected by most of the consensus so far this year.
Also, like front-running tech earnings on that seems to be a question mark too. But Gina, to your point, the Russell 3000 growth to value ratio has really been recovering lately, and we're at some key levels here. If yields stay somewhat contained? What is the ability of growth, aka tech, to really break out?
That's where then earnings come into the story, because I think the growth value equation has been more than just about rates, but it really is also about earnings, as you suggest. When we look at earnings trends overall, it's also a story not just of growth earnings underperforming now, but increasingly expected to underperform into the future. The revision trend for growth stocks has been tremendously negative, not just for tech, but also for consumer stocks at large. Some of the media companies also have seen very vicious downward estimate revision momentum, where value stocks are still seeing positive estimate revision momentum. So I think you do need to find some sort of movement in estimate revisions to really justify the case for growth stocks to be able to break out, and we're just not seeing that yet.
Alex, where do we stand on some of those mega cap tech stocks that are difficult sometimes to categorize? Yes, they're still growing hugely, but they're also really, really profitable. So in terms of their characteristics, they may behave differently. I mean, Amazon, for example, you were telling me before the program, still trades at a big premium.
Yeah, Amazon trades at about 40 times forward earnings, and there has long been the expectation with Amazon that all they need to do really is they can sort of twist the spigot and earn cash whenever they need to. Now, there was a slight wrinkle to that story earlier this year when it became clear they had perhaps overspent on new capacity in terms of warehouses, in terms of data during the lockdowns, and that there needs to be a course correct. They weren't able to twist that spigot as readily as they might have done before. Now, of course, Apple, I think at this stage, maybe you could say, even though it continues to grow, is considered something of a value stock. I'm really interested to see what happens with Netflix, because we've seen a lot of the streaming companies say, Disney, for example, classic example, it's said, no, we're a growth stock. We are going to grow, and that's how you should value us. Netflix isn't really growing anymore, has been valued as a growth stock. Can it start generating or returning cash flow to shareholders in a way that maybe ports it towards becoming more valued?
Hey, Alex, when we see a pause in hiring for the likes of Apple, et cetera, IBM warning for a second time on the dollar, et cetera, do we get a feeling, when do we go from we're just not going to grow more to an actual slowdown for these companies?
Certainly for Apple, they have been able to eke growth out by all sorts of means. Even if the iPhone numbers have slowed down, they've managed to find new ways of wringing dollars out of their customers. They have, if you think about the lifetime value of an Apple customer, which people don't often tend to do, it is vast when you compare it to even a telecoms company, which tends to have pretty stable returns. IBM is a little bit different. It has experienced slowdowns in recent years, and most of its growth tends to be in the sort of 3 to 5% range. So clearly there's a difference between those two companies. Apple, it may be at times show signs of slowing its pace of growth, but it still finds ways of eking out more profit.
Gina, how do you look at tech stocks in Europe versus tech stocks in the US? They're very different, of course, and in the US there's more of the sort of social media side, the more the tech stocks that rely on advertising revenue, for example, as well as, of course, the tech companies that make things. In Europe, they tend to be parts of the plumbing, so something like ASML, big tech, chip equipment manufacturer. How do you stand on the different types of tech stocks on both sides of the Atlantic?
Yeah, I think it's a very good point, and they also have consequences for the market at large, where tech is such a giant chunk of the U.S. equity market and a much smaller share of the overall European equity market. So the consequences of interest rate rises are very different on those markets. Where tech is still long duration in Europe, market cap share is significantly lower. It's significantly more focused on just a handful of companies, whereas it's a big, broad theme in the U.S. We did not see the characteristics of a bubble emerge, for instance, in European tech, where we did see that emerge in U.S. tech, really concentrated in some of the consumer and media space when we had nothing left to do. We were sitting at home consuming a bunch of media, and that got embedded in prices. That's not been the case in the European tech shares. So you do have two very different worlds. I think with respect to European tech, it really is about those companies specifically, because the companies all operate in different industries. You have very big bellwethers in those industries in tech in Europe, but it's the companies rather than the narrative and the theme, which is more what drives the U.S. tech space.
Alex alluded to it, Apple being sort of a value tech stock. Is value tech a thing?
Yeah, it's a good question. We go through this all the time. Certainly there are tech stocks that are now tremendously discounted relative to long term, and the semiconductor space in particular tends to go in and out of value more than the other segments. I think over the cycle, you do have tech stocks become value stocks. They move into the value index, but most of those big mega cap companies are not value stocks yet. We still don't see the depressed valuation ratios. We still don't see enough dividend coming out of those stocks. So I think that it depends on the company at large and even the industry in which the company resides.
Gina, thanks so much. Thanks to Alex Webb from Bloomberg Quick Take and Gina Martin-Adams of Bloomberg Intelligence. Thanks to both of you. Really interesting conversation about where the tech story goes from here as we find ourselves midway through the tech earnings season, I suppose, knowing some things, but certainly not having great visibility. Let's just get to UK politics. We've got some breaking news coming through on the battle to become the next leader of the Conservative Party and, by default, the next UK Prime Minister. And we are learning a little bit more about the shortlist, and it is getting shorter of people in the running. Kemi Badenoch, who was in the running up until today, has just been announced. She has been eliminated in the most recent round. She's the former Equalities Minister. She's now out. Rishi Sunak, who you see on the left of your screen there, he, of course, formerly the Chancellor, resigned that position with great fanfare, in the end triggering the downfall of Boris Johnson as Prime Minister. He has been at the front of the pack in all of these votes, so we'll certainly watch him to go through to the final two. And then it'll be between Penny Mordaunt, that's the other lady you see, not so well known to international audiences, has been a trade minister. Foreign Secretary Liz Truss also in the running. So we'll see who out of Mordaunt and Truss goes through up against Sunak. That looks at the moment to be the likely outcome, but we will have to get confirmation of that this time tomorrow. Coming up on this programme, more on our question of the day. Is it time to buy tech? If it isn't, what are you waiting for to give you a sense of whether it's good to buy tech? We'll discuss attractive areas in tech with Nadia Lovell of UBS Global Wealth Management. This is Bloomberg.
Sponsor Bank of America.
Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Valuations are at a much more reasonable place than they were 12 months ago. Globally, you've seen multiples have compressed around 30%. They're down about 40% in Europe. So I think we're closer to a bottom. I think the market's in the process of making a bottom. But all of the conditions that led to the volatility, unfortunately, they have not gone away yet.
That was BlackRock's Russ Kosterich earlier on Bloomberg TV. That takes us back to our question of the day around tech. Is it time to buy tech? Let's bring into the conversation Nadia Lovell, UBS Global Wealth Management Senior U.S. Equity Strategist. Nadia, really nice to have you with us. Is it time to buy tech? Have we worked through the valuation headwinds that a lot of people have talked about over recent months? And if we have, and you don't think it's time to buy tech, why not?
Yeah, yes, some of the valuation headwinds is behind us, but it's still a tough environment for tech when the Fed is still on a hiking path. And quite honestly, we're still seeing some weakness in the consumer segment of the tech, whether that's PC or smartphone. There's also concerns around semis, and over-ordering in some of those areas, and then concerns within software and the pull forward of that demand. And so, we're also seeing an increasing number of tech companies talk about layoffs or hiring freezes. So we're still neutral on the sector. Valuation, of course, has come in quite a bit, but this is a sector that's still trading at a 20% premium. Pre-pandemic, that premium was more like 5%. But I will say that there's still some areas of tech that we find interesting at this point that are more tilted to those longer-term secular trends, whether that be artificial intelligence, big data, cybersecurity, automation. So there might be some opportunities there.
Nadia, it feels like the yield curve and investors are kind of looking at that recessionary fear, right? Hike now, pay for it later. And if we get into that recessionary environment and that fear goes more mainstream, growth is going to be a lot more scarce. Is that, how do we know when it's going to be time to buy tech to protect against that kind of scenario?
A recession isn't our base case, but of course the probability of recession continues to move higher. In that sort of scenario, as we're coming on the other side of it, then I think that tech becomes more interested. But right now, we're also looking more closer to the value side of the equation, which tech doesn't fit. Because when you look at the historical data, in periods of inflation above 3%, which we can all agree we're going to be in that range for quite some time, value tends to outperform growth when we know that tech tilts more towards growth.
And I know that on that front, Nadia, you're looking at defensives and quality, and one of those areas you focus on is energy. Where in the energy space do you think you're going to see the benefits of the disruption that we're seeing in many of the underlying commodity markets right now?
Within energy, of course, we continue to rate. We're buyers on this pullback. I think within energy, given the long period of underinvestment in this space, we're looking at the oil services company. We're also looking at liquefied natural gas. We see the crisis that's upon us in Europe, and so we think that there's going to be increased demand for that. And so those are the areas, and some of the refineries, just given the spread that we're seeing in the marketplace, those are the areas of energy that we particularly like at this point.
Hey, Nadia, I want to bring the attention to Bank of America Fund Manager Survey. It's always a fun one to check out. And this one was particularly interesting. And this was for the previous month. But they say that investors are in full capitulation mode. They talk about a dire economic outlook. Cash levels are at the highest since 9/11. Equity allocation is like we haven't seen since Lehman collapsed. Biggest longs are oil, dollar, and commodities. What's your takeaway from something like this? Have we seen capitulation? Do we need to start thinking more counterintuitively?
I don't think that we've seen full capitulation. Of course, there's debate in the marketplace as whether we're heading towards recession or a soft landing. That will take some time to work itself out. I mean, quite frankly, now this downside scenario for the S&P 500, which assumes a mild recession, and we know those probabilities are going up, we're looking for 3,300 on the S&P 500. And so we could retest those recent lows that we have seen. So we don't think that full capitulation has happened yet. But at the same time, doesn't mean that there aren't things to do in the market. You're seeing in the manager survey that position in energy. I would also highlight healthcare on the more defensive side in this marketplace as you sort of wait out and see. There's been some noise recently around drug pricing, but we ultimately think that will be a clearing event. And this is a sector that consistently has the earnings growth that you're looking for in this marketplace.
One of the other big themes we've talked about a lot recently, Nadia, has been the strong dollar, and that's starting to have an impact on the earnings reports we see. We saw that from IBM talking about strong dollar. That's a business that, of course, does half of its business outside the United States, and so that translates poorly from other currencies back into US dollars. Is that going to be something that's going to hurt big US businesses with those big global footprints, Nadia? Is that going to be a theme worth watching through earnings season?
Absolutely. You know, the dollar is at a 20-year high. And so, you know, those companies with ex-U.S. earnings, particularly tech and healthcare that are more exposed relative to the rest of the S&P, that's going to be a near-term headwind. So probably a couple of percentage points being shaved off of their growth. But in our core view, you know, we think that there's limited upside to the dollar from here. We actually moved more recently to a more neutral view because we do think that as the economy in the U.S. slows down, as the Fed comes closer and nearer to the end of its hiking cycle, then you should see the some of the pressure, the upward pressure on the dollar relief. I mean, we're looking for on the 10-year 3.25, and we think that the Fed funds rate is going to peak at 3.25%.
Hey, Nadia, it's so good to catch up with you. Really appreciate the insight. Nadia Lavelle of UBS Global Wealth Management. Let's stay with earnings for a second. We get Netflix results after the bell. Investors looking for signs the company has found that way to end those massive subscriber losses. Ad companies chomping at the bit here. We'll break it down more. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Halliburton has posted its biggest profit in almost 4 years. The world's biggest provider of hydraulic fracturing is almost sold out of gear in the North American market. That includes the most prolific shale oil fields. Halliburton also recorded a $344 million charge related to winding down its business in Russia. Shares of Lockheed Martin are trading lower. The defense contractor cut its forecast. It also said it has yet to finalize a long-awaited new contract with the Pentagon for production of the F-35. Late Monday, the Defense Department said there was a preliminary deal for 375 of the stealth fighter jets. And China reportedly will fine ride-hailing giant Didi Global more than $1 billion, according to the Wall Street Journal. Beijing will then allow the company to restore its main apps to mobile stores and add new users. Investors have been awaiting the penalties for Didi since China launched an investigation last year into potential violations of data security. And that is your latest business flash, Alex.
All right, thank you so much, Ritika. So let's get back to earnings here. Netflix surprising investors in April when it reported that big subscriber loss. It did warn of worse things to come. And just a few hours from now, we're going to see what that means for Netflix earnings. Joining us now is Geetha Ranganathan of Bloomberg Intelligence. The stock has just been really seriously crushed, Geetha. What are you expecting today, and what's kind of already priced?
Yeah, this has been a complete train wreck, Alex. So, you know, we are obviously bracing for subscriber losses again in the second quarter. The company has guided to about 2 million, and that's kind of what we're expecting as well. Even if they report a slightly better than expected number, so fewer losses, I don't think it's necessarily going to result in any turnaround. The sentiment has been very, very negative, and there's really, really a lot of cautious, a very cautious tone going in because visibility is extremely limited. We think that there's going to be a lot of turbulence. There are a lot of downward pressures on the subscriber story, whether you're looking at inflation, whether you're looking at recession, just so many, this perfect combination of headwinds, if you will, affecting the whole narrative at Netflix.
Yeah, absolutely. So a lot they need to prove today, I suppose. What would a good result look like, Geetha? Can they draw a line in the sand?
So I think one would obviously be the 2Q numbers themselves. If they come in slightly better than expected, and what we're looking at is 2 million losses, so even fewer losses could give a little bit of optimism. But I think what the number that we're really looking for is the 3Q guidance. But there, right now there's just so many different factors working against Netflix. Whether you're looking at rising competition, whether we're looking at elevated churn levels, and so there is now this whole concept of whether we're going to see, we've seen cord cutting, which is people kind of letting go of their TV subscriptions. The question is now, are people, as they kind of tighten back on their spending, as they pull back spending, is there going to be stream cutting? Are they going to let go of some of their streaming subscriptions as well? And so that is another factor that we have to, look at, when we kind of look at what Netflix is going to do tonight.
Geetha, thank you very much. Geetha Ranganathan of Bloomberg Intelligence getting us ready for those Netflix numbers. Let's also get ready for developments on Thursday. There'd been a lot of focus on the pipeline from Russia to Europe in terms of gas, Nord Stream 1 this is. We're just getting some lines coming through from Reuters, Alex, that say Russia is seen restarting the Nord Stream 1 pipeline on Thursday. And this is going to be really crucial to watch because we just heard from the European Commission earlier on today. They're now assuming no restart.
Right, and they were already at 40% levels before the shutdown. And also, even if it restarts, can it also get turned off on Friday? I don't really feel like this solves the underlying problem at the end of the day.
Yeah, absolutely. Certainly the market is unsure what to do with this information. The benchmark Dutch natural gas price is dropping, but, moving around quite a bit on this news flow. We'll get more details, hopefully. Coming up, taking the pulse of small business. We will talk to John Waldron, Goldman Sachs President and COO, and Jessica Johnson-Coke, President of a family-owned business. This is Bloomberg.
About that all day yesterday.
All right, we're an hour into the U.S. trading session. Stocks right around the highs of the session. Bloomberg's Kriti Gupta is looking at some of these moves for us. On high volume, too, I should say. Kriti.
High volume, and that's the really key part here. We saw a lot of conviction selling to the downside. The question is, do you have conviction buying to the upside? Today, it does seem like that seems to be the trade. But to be fair, that was the trade yesterday as well until we got those Apple headlines about slowing hiring. That completely turned the market around. So it really is anyone's game at the moment. Well, let's stick with that tech story because that is one of your major downside movers this morning. A slew of earnings coming out at the top of the heap. IBM down 6.7%. This is huge as we talk about what is actually driving the trade here. And we're talking about these dollar warnings over and over and over again. IBM coming out saying they're worried about that dollar strength. In fact, if you look at their segment revenue and their geographic breakdown, 51% of their revenue comes from outside of the Americas. That is huge when it comes to that currency conversion story coming right back into the States. And really, it brings it back down to what the dollar is doing. Today, perhaps not stronger, but the upward trend is still consensus in terms of what we've been seeing. Just a little bit of a breather in a long-term basis. The dollar is actually where I want to go next in terms of what kind of price action we've been seeing lately, specifically when you have had this massive uptrend. This is your third day of a weaker dollar. Once again, it's not that dollar weakness by as much of a margin as you saw climb to the upside, and that's really where a lot of the concerns lie. Nevertheless, going back to the stock market here, you are seeing a very broad rally. Even some of your more interest rate sensitive sectors like financials, for example, well, they're notching a third day of gains. That is going to be extremely significant when you look at the likes of Bank of America, Goldman Sachs, JP Morgan, but really the KBW Bank Index as a whole. Like I said, third straight day of gains, 8.3% gains during that period. But take a look at the other side of the spectrum here on the tech story, because even the chip sector is actually higher, really awaiting that Senate procedural vote on that CHIPS Plus Act. We've got to talk about some of the exceptions, though. There are exceptions that actually perhaps limit some of the grants that are being used. Nevertheless, on the surface, you are seeing both sides of the economic spectrum, the value trade in financials and the defensive trade in tech, both thriving this morning, Alex.
All right, thanks so much, Kriti. Really appreciate Bloomberg's Kriti Gupta joining us there. All right, let's turn now to the health of the economy, in particular, small businesses. Goldman Sachs is holding its 10,000 Small Businesses Summit over in Washington. That's where business owners get the chance to meet with members of Congress. Now, joining us from there, John Waldron, Goldman Sachs President and COO, and Jessica Johnson-Cope, the President of Johnson Security Bureau. And Bloomberg's Emery Hordern is also there. Emery, I'll take it over to you.
Thanks so much, Alex, and thank you, John, for hosting us here at the Small Business Summit. I want to start out with this dire report the bank put out about the sentiment of the small business environment. 92% fear recession, and overwhelmingly the concerns still are biting that we saw coming out of the pandemic: inflation, supply chain issues. Similar problems that you see in the C-suite, concerns, but small businesses don't have the same kind of cushion to deal with it. How are you communicating with small businesses? What are you telling them to prepare for this next phase?
Well, first of all, we appreciate the opportunity to be here. We're hosting 2,500 of our small business graduates from our 10,000 Small Business Program here in Washington, D.C. It's our opportunity to convene this group and really celebrate the resilience of small business in America. This is an incredibly important economic engine and job-creating engine in America, and we're here to celebrate that and really talk about how we can deal with the economy going forward. So to your question, we're talking to the small business owners just as we're talking to large business owners about how to navigate the inflation environment, how to navigate workplace challenges, how to navigate the supply chain, finding ways to think about financing yourself for longer term, thinking about putting in place provisioning so that you can ride through an economic downturn, really planning for the worst and hoping for a better outlook, but really having the plans in place to deal with a tougher outlook.
And Jessica, you're one of these original small business owners that worked with Goldman Sachs when they launched this. What are you feeling right now in the economy? Like this report that came out listed a slew of issues. What's number one top priority?
So number one, in many of the small businesses with whom I talk to here at the summit, is workforce. We understand that small businesses are the engine that drive the economy and drive this nation. And so we are very aware of the challenges in the economy with inflation and the supply chain challenges. We also know that we can make a great impact. And we're able to apply many of the learnings that we've received in the Goldman Sachs 10,000 Small Businesses program to navigate those challenges. And so when we put people to work, we're making an impact in our community, we're making an impact to the tax base. So I am optimistic about what's to come in light of inflation and the supply chain. And from what I'm hearing from my peers here, which is the largest gathering of small businesses to convene in the nation, they're optimistic as well. And in the past 2 years, they've had tremendous growth in spite of the pandemic, in spite of the lockdowns, and we're looking forward as to what's to come in the next 12 to 18 months.
You talked about labor and employment being one of these high issues. Yesterday, you had earnings at Goldman Sachs, and there's this line that everyone's talking about, slowing hiring velocity. Are you recalibrating for the next phase? Are you preparing for slower growth? Well, what does that mean?
What it means in plain English is we're hiring fewer people, but we're still hiring. It's an important distinction. We've hired a number of people in the last couple of years as we've executed on our growth plan. We've grown the firm quite considerably. We've built new businesses and new platforms, and we've needed a lot of incremental people to execute upon that plan, and we still do need those people, and we're continuing to grow. But we are going to grow at a slower pace in light of the economic situation that we see in front of us now and that we forecast could get worse from here. So we have to plan and calibrate accordingly. But we continue to invest in our human capital. We will continue to hire. We will continue to grow.
And what's also coming back is those reviews at the end of the year. So potentially planning to get rid of more people that are maybe weighing down the business?
I think there might have been some confusion in reaction to what we said. We always do performance evaluations at the end of the year. We always like to give our people feedback. That really has nothing to do with whether we're reducing headcount or increasing headcount. It's giving feedback and evaluation to our people, which is the right thing to do as you're developing your human capital.
The other thing Jessica mentioned was inflation, and I have to ask you, in January, you were quite critical of the Fed. Potentially they were behind the curve. You even said at this point we should bring back Paul Volcker. So far, are you satisfied with what the Fed has done?
I think you're seeing the Fed move quite aggressively, and in my opinion, very appropriately to get on top of what's significant inflation building in the economy, and clearly trying to front load a lot of the moves, policy moves, to try to deal with inflation. And so we at Goldman Sachs are impressed with what they're doing. We expect them to continue to be aggressive in combating inflation, and I'd say so far so good.
Combating inflation also potentially means a recession. We're going to get GDP figures, which right now the data shows potentially a technical recession in the United States. How, as a small business, do you plan for that?
You know what, I think that means a greater opportunity for small businesses. So wherein some of the large corporations may be reducing their workforce or hiring at a slower pace, those are people that are now able to come work for smaller businesses like mine, where if given a chance, they will go to a large corporation if those opportunities are there. So we're looking at how do we scale. And one of the reasons we're here is because we'll be able to talk to our elected officials, the congressional representatives tomorrow during our advocacy day, and talk to them about what our businesses need to not only survive, but to thrive. And to stress to them our legislative priorities, which are better access to government contracts, access to capital, workforce development, grants and programming, and the like. And so those are opportunities for small businesses like mine to grow. And even in spite of the technical recession, I think that we'll do pretty well.
Jessica and John, hey, it's Alex in New York. It's really great to see you both. I've been at those events, and they're super fun, so I'm excited that they get to happen again. John, it's been a while since we've last talked, and I just wanted to sort of pick up on what you were saying about the Fed. You think that they've done a good job, they're moving aggressively and appropriately. That Fed put that many in the market are used to is done and dusted. What happens then on the other side of a potential recession? Does that distort the market or make the market more difficult going forward?
Good to see you or talk to you, Alex. I appreciate the opportunity again to be here. We are forecasting a terminal rate, kind of in the mid 3% range. So, were we to end up in that place, we could see the economy actually resetting and being able to grow from there. I think it's important to reset the price of money in the economy, which is something I think the Fed is very focused on. And I think ultimately focused on growing the economy from there and growing jobs and really getting back to a more sustainable pace of growth as we're coming on the other side of the pandemic and really dealing with a series of shocks to the economy. We've been living in a very unnatural environment for some time now. And I think we have to get to a place where we can get to a more sustainably long-term, durable growth pattern in the economy.
Yeah, and that sort of brings the question, like, what happens to loans to capital markets and funding to lower quality companies. I mean, the leveraged loan market recently has just been taken out to the woodshed. PIMCO bought some euro debt today at a good solid discount. It's like you can still do the deals, but it's at a different price. What happens to the lower quality, John, in that environment that you just laid out?
Well, you'll probably see continued spread widening and more difficult financing environment for lower quality companies. But we still see buyers for credit at different prices. The market's repricing itself as is appropriate. But doesn't mean that there aren't buyers for credit. There'll have to be a new equilibrium, and the market will find its way and find that equilibrium, and we'll be able to prosecute capital markets transactions as we get through that repricing mechanism.
When things are doing that and they're selling off and they're cheaper, where's the opportunity in the volatility, John, to buy something really meaningful? Like, how do you look at it?
Well, I think you're going to see very good companies that probably have imperfect capital structures that need to get repriced, and there'll be opportunities in there. And typically lots of pools of capital get assembled to go look at those opportunities, and I think this will be the same as we see in most cycles. So there'll be plenty of opportunities to buy good companies that have some capital structure challenges that need to be repriced and restructured and reset.
I just want to close out with, you mentioned you're excited to talk to elected representatives. What's the message you want to ask from them? Because during the pandemic, there was loans they were giving out to small businesses. There was tax credits if you had children. What more should Washington be doing to support small businesses?
I think it's threefold. Number one, listen to small businesses. We had Mayor Mike Bloomberg earlier today give us an encouraging keynote speech about believing in small business and how we can move forward. And so many elected officials don't know the small businesses. Have a conversation with the small businesses in your district and hear what those challenges are. And like I said, those challenges include workforce development. It's not necessarily about grants or loans, but overall access to capital and opportunities. We don't want a hand out, we want a hand up. And so equal access to and equity in procurement opportunities will be extremely helpful. Those are the key things that we're looking for. And last but not least, to reauthorize the SBA. It's been nearly 20 years since the SBA has been reauthorized, and I think that that's a great opportunity for the federal government to really have a pulse on what's going on with small businesses and be able to impact us, because I believe in small businesses. Small businesses believe in this nation, and we can have a stellar impact on what's to come with the economy.
John, do you like what you're hearing quickly out of Washington in terms of the economy?
I couldn't echo more what Jessica just talked about, the reauthorization of the Small Business Administration Act and really taking a fresh look, which hasn't been looked at in over 20 years, to really enable and empower small businesses, which employ over 50% of the workforce in the private sector in this country. Incredibly important. It'll be one of the major themes of our discussion over the next couple days, including in these 400+ meetings with lawmakers tomorrow. So we're big supporters of small business. It is an economic engine in this economy, and we're thrilled to be here today in Washington.